What's up, everyone? It's Vaughn here. Who doesn't want to make more money? While most people think about working another job or picking up a side hustle, there's a whole world of wealth building happening right now in the stock market. Whether you've got a few bucks to invest or you're ready to dive in head first, you don't need a finance degree or to be some Wall Street hotshot to make the market work for you. What you do need is the right knowledge and a solid strategy. In this video, we're breaking down 5 proven methods to make money in the stock market, from long-term strategies to shorter-term tactics that can seriously amplify your returns. Welcome to our channel. Today we're diving into 5 proven ways to make money in the stock market. Whether you're a beginner or looking to refine your strategy, these tips will help you navigate the world of stocks with confidence. Alright, let's kick things off with the strategy that built Warren Buffett's fortune: buy and hold. This approach is not just a method, it's a philosophy that has stood the test of time. Warren Buffett, one of the most successful investors of all time, has consistently advocated for this strategy, and for good reason. The basic idea is that you're not trying to time the market, you're playing the long game. Instead of getting caught up in the daily fluctuations of stock prices, you focus on the bigger picture. This means looking at the overall growth potential of the market over many years. You're buying shares of companies you believe in and holding on to those shares for years, even decades. The key is to choose companies with strong fundamentals, solid management, and a competitive edge in their industry. This requires thorough research and a deep understanding of the businesses you're investing in. The buy and hold strategy is all about slow and steady wins the race. Just like the tortoise in the famous fable, this approach emphasizes patience and consistency. It's not about making quick profits, but about building wealth gradually over time. It's like watching a tree grow. It might not seem like much is happening day to day, but over time, that little sapling can grow into a massive oak tree. This analogy perfectly captures the essence of the buy and hold strategy. The growth may be slow, but it's steady and reliable. The beauty of buy and hold is that it's a relatively passive investment strategy. Once you've made your investments, there's no need for constant monitoring or frequent trading. This allows you to focus on other aspects of your life while your investments grow in the background. Once you've done your research and invested in companies you believe in, you don't have to do much. The initial effort is in selecting the right stocks, but after that, it's mostly about patience and letting time do its work. This can be incredibly freeing compared to more active trading strategies. You don't need to be glued to your computer screen. You can just sit back, relax, and let your money work for you. Imagine enjoying your leisure time, knowing that your investments are steadily growing. This is one of the most appealing aspects of the buy and hold strategy. When you hold on to stocks for the long term, you benefit from the power of compounding. Compounding is when your investment gains start generating their own gains, creating a snowball effect that can significantly boost your wealth over time. As your investments grow, those gains are reinvested, and then those gains start earning gains. This cycle continues, and over the years it can lead to substantial growth in your investment portfolio. The stock market can be volatile, and there will be times when the value of your investments goes down. It's important to stay calm during these periods, and not make hasty decisions based on short-term market movements. But remember, over time, the stock market has historically trended upwards. By staying invested and not reacting to short-term volatility, you position yourself to benefit from the long-term growth of the market. This is the essence of the buy and hold strategy. Now, let's talk about dividends. With dividends, you're essentially getting a piece of the company's profits just for being a shareholder. Think of it like owning a rental property, but instead of collecting rent checks every month, you're collecting dividend checks every quarter. Not all companies pay dividends, but the ones that do are typically well-established companies with a history of profitability. These companies have weathered their fair share of storms and are still standing strong. Dividends provide you with a steady stream of passive income. Whether the market is up, down, or sideways, those dividend checks keep rolling in. Look for companies that have a history of increasing their dividends year after year. These are known as dividend aristocrats, and they're like the royalty of the dividend world. Over time, those dividends can really add up. Reinvesting those dividends can supercharge your returns, turning a modest investment into a significant nest egg. Dividends are not guaranteed, and companies can cut or eliminate their dividends. So if you're looking for a way to generate passive income from your investments, dividend investing might be the perfect strategy for you. Now let's shift gears and talk about trading, which is a completely different beast than buy and hold or dividend investing. Unlike these more traditional strategies, trading is all about seizing short-term opportunities and making quick decisions. While those strategies are about playing the long game, trading is about capitalizing on short-term price fluctuations. It's a fast-paced world where every second counts, and the ability to act swiftly can make or break your success. Think of it like surfing. You're trying to ride the waves, catching the upswings and getting out before the downswings. Just as a surfer needs to read the ocean, a trader needs to read the market, anticipating movements and reacting accordingly. There are different types of trading, from day trading to swing trading. Day traders buy and sell within the same day, while swing traders hold positions for several days or even weeks, aiming to profit from short to medium-term price movements. But no matter what type of trading you're doing, the goal is the same: to buy low and sell high. This fundamental principle drives all trading activities, regardless of the time frame or strategy employed. The allure of trading is undeniable. The potential for quick profits is exciting. The idea of making significant gains in a short period is what draws many people to trading. But trading is not for the faint of heart. The same volatility that offers the potential for quick gains also brings the risk of rapid losses. It's a double-edged sword that requires careful handling. It requires a deep understanding of the markets, a disciplined approach, and a willingness to take on a higher level of risk. Successful traders spend countless hours studying market trends, developing strategies, and honing their skills. Unlike buy and hold or dividend investing, where time is your friend, time is the enemy in trading. The longer you hold on to a trade, the more time there is for the market to move against you, increasing the potential for loss. The longer you hold on to a trade, the more time there is for the market to move against you. This constant pressure to act quickly can be both exhilarating and exhausting. Successful traders rely heavily on technical analysis, using charts, indicators, and patterns to identify trading opportunities. They look for signals that indicate when to enter or exit a trade, aiming to maximize profits and minimize losses. Even with the best tools and strategies, trading is still a risky endeavor. The market can be unpredictable, and even the most experienced traders can face unexpected challenges. The market can be unpredictable, and even experienced traders can lose money. It's important to be prepared for the possibility of losses, and to have a plan in place to manage risk. So, if you're new to investing, I highly recommend steering clear of trading until you've gained a solid understanding of the markets. Start with more stable, long-term strategies and gradually build your knowledge and experience before diving into the high-stakes world of trading. Now let's say you're looking for a way to invest in the stock market, but you don't have the time or desire to research individual stocks. The stock market can be overwhelming, with its constant fluctuations and the sheer number of companies to choose from. It can be a daunting task to pick the right stocks, and the fear of making the wrong choice can be paralyzing. That's where index funds and ETFs come in. These investment options are designed to simplify the process for you. These investment vehicles allow you to invest in a basket of stocks with a single purchase, making it easy to diversify your portfolio and reduce your risk. Diversification is key to managing risk in investing, and index funds and ETFs make it accessible to everyone. Think of an index fund or ETF like a giant basket of stocks that tracks a specific market index, like the S&P 500. This means that instead of buying individual stocks, you are buying a piece of the entire market. When you invest in an S&P 500 index fund or ETF, you're essentially buying a tiny piece of all 500 of those companies. This gives you exposure to a wide range of industries and sectors. The beauty of index funds and ETFs is that they provide instant diversification. This means that your investment is spread out over many different companies, reducing the impact of any single company's poor performance on your overall portfolio. Instead of putting all your eggs in one basket, you're spreading your risk across hundreds, even thousands of companies. This approach can help smooth out the ups and downs of the market. Index funds and ETFs are incredibly low cost, much lower than actively managed mutual funds. This is because they are passively managed, meaning they simply track an index rather than trying to outperform it. They're not trying to beat the market, they're simply trying to track it. This passive approach keeps costs down and can lead to better long-term returns for investors. While index funds and ETFs might not offer the same potential for outsized returns as picking individual stocks, they offer a level of simplicity and peace of mind that's hard to beat. You don't have to worry about the performance of individual companies. You can just set it and forget it, knowing that your money is invested in a diversified portfolio of stocks. This hands-off approach allows you to focus on other aspects of your life while your investments grow over time. Finally, let's talk about options trading, the most complex and riskiest strategy we're covering in this video. Options trading is not for beginners and requires a thorough understanding of how options work. An option is a contract that gives you the right, but the obligation, to buy or sell an underlying asset at a specific price on or before a specific date. There are two main types of options: call options and put options. A call option gives you the right to buy the underlying asset, while a put option gives you the right to sell the underlying asset. Options traders use these contracts to speculate on the future price movements of underlying assets. The potential for profit in options trading is significant, but so is the potential for loss. Options trading requires a deep understanding of options pricing, volatility, and risk management. It's not something to jump into lightly and is best left to experienced investors. If you're interested in learning more about options trading, I recommend doing your research and seeking out educational resources. Remember, options trading is a high-risk, high-reward strategy that's best left to experienced investors. So, there you have it. 5 proven ways to make money in the stock market. Whether you're a beginner looking for a hands-off approach with index funds or a seasoned investor exploring the complexities of options trading, remember that knowledge is power. The stock market can be a powerful tool for building wealth, but it's essential to approach it with a clear understanding of your risk tolerance and investment goals. Don't be afraid to start small, learn as you go, and never stop educating yourself about the ever-evolving world of finance. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on investing and personal finance. Drop a comment below with your favorite stock market strategy.